Meantime, FedEx has taken investors on quite a ride these past few months with some pretty big swings. Our next guest is keeping an eye on the stock and is here to tell us where he thinks the delivery giant is headed next, especially with its quarterly report right around the corner. Joining us now is Mike Khouw, chief strategist at OpenInterest.PRO. Mike, welcome. Good to have you with us. What has FedEx typically done around earnings, and how does that inform any trading strategy that you're following right now?
Well, this is a company that, historically probably moved 7 to 8% each time they reported. But over the last 4 quarters, the moves have been considerably sharper than that. It has averaged about a 12.5% move on average over the last 4 reported quarters. And I think that is one of the reasons why right now the options market is implying a move of about $28 higher or lower by the end of next week. So about 10% of the current stock price. Now, I would say that the sentiment has also deteriorated a little bit going into that earnings number. So yesterday we saw nearly double the average daily put volume. And if we take a look at the prices of upside calls relative to the downside puts, we've seen that those calls have kind of deteriorated a little bit, indicating that sort of bearish sentiment, if you will. And today we are seeing, once again, put volume outpacing the call volume just a bit. So as I take a look at this, I think one of the things that you could do, trying to take advantage of that elevated short-term options premium going into the event, is trade a downside put calendar. So this isn't a sharply bearish bet. It's a modestly bearish bet. I was looking at the 260 strike, so selling the December 260 puts to collect that elevated premium, and then going out to March, the 21st expiration, and buying the 260 puts there. And the idea is that on a standstill basis, you'll probably make a little bit of money. If it drifts down to that 260 level, you would make some money, bearing in mind that 260 is where the stock fell to actually the last time that they reported earnings. So, 15 times earnings, not hugely expensive relative to the market, but it is a cyclical. It is, typically trading at a material discount to the S&P.
You said that the options action that you've been watching recently is suggesting a little bit more of a bearish tilt. Is the activity heavier than normal, roughly normal? How would you characterize it?
Yeah, so I think yesterday we saw about double, actually, the average daily put volume. So it traded over 11,000 put contracts. 11,000 doesn't sound like a big number, but every put contract represents 100 shares. So that's really, over 1.1 million shares in bearish bets, if you think about it that way, times the $280 stock price. You're talking about $250 million in notional exposure to the downside, and that was indeed above average.
So just so we leave the viewer with a clarity here, go back very quickly over what your trade is. It was a 260 put. I'm sorry?
Yeah, it was a 260 put calendar. So buying the March 260 puts and then selling the near-dated December 260 puts against it. The idea being that if the stock drifts to that lower strike, which is where the stock fell to, you're going to capitalize on the decay of that near-dated option, but still have some bearish exposure. And by the way, that longer-dated 260 put will capture the next quarterly report, which they're going to be giving in the 3rd week of March.
Mike Khouw, one of the few people who can make me understand options. Mike, thank you, as always. Appreciate it.